Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to another episode of the Treasury Update podcast. This is your host, Brian Weeks, and today I am sitting down with Paul Galloway, Senior Advisor here at Strategic Treasurer. Paul, it's always good to have you on. Thanks for being here.
Yeah, thanks for having me, Brian.
Today we are talking about a topic that I find particularly interesting because it's relevant to both corporates and us as individuals, the 10-year yield. Today's episode is titled Reading the Curve, Decoding the 10-year yield. So Paul, before we dive into this, maybe I thought we would start with some fundamentals. What is the yield curve and why is it important?
Yeah, I think that's a great place to start. Some people might not even think about yields or what a yield curve is and why it's important. And it is really important to a lot of individuals and corporates, not just here in the U.S., but globally. The U.S. yield curve is followed closely. So the yield curve is just a picture. So think about, you're looking at a piece of paper and you draw a vertical line on the left side and you plot yields, maybe from 1% up to 10%. And then on the bottom, you start from the left side and draw a horizontal line left to right, and you put down maturities, 1 month all the way up to 30 years. And then you plot what the current yields are for each one of those maturities in this graph. And as you plot that, connect the lines, that's the yield curve. That's essentially what it is. It's giving you a picture of what yields on bonds are currently at, and it provides you information. So just generally, what some of the reasons of why the yield curve is important. One is as an economic indicator. The yield curve can help predict changes in economic output and growth over time. So a normal yield curve would slope from left to right upward. So the yield curve starts out lower and then it steepens as you move to the right as you're looking at the picture. So you get longer maturities, you have higher yield. This indicates growth in investor confidence. If it's downward sloping, this means that the short-term rates are higher than the long-term rates. And so you might not have exactly from left to right. It starts up higher on the short end of the yield curve down to the 30-year rate. But you might have a little bump, it goes up and then it goes down. That would be a downward sloping yield curve, and that suggests that there may be an economic recession. Either you're in one or one is coming. Now, keep in mind, these are just indicators. It doesn't mean for sure that that's what's going on out there. It could be what's happening economically today, or it could be foretelling of what's to happen. Another area is investment decisions. And so investors make decisions about where to invest along the yield curve. And when I say that, I mean what types of maturities are appealing to them. And so if you're an investor and you think that the yields on long-term bonds are going to drop, so you're going to invest in a bond that is long dated, but you think the yields on those are going to drop, you might invest in those. You might ask yourself, well, why would you do that as an investor? Because that seems counterintuitive. If the yields are going to drop, why would you invest in a long dated bond today that has, let's say a 7% yield, and you think yields are going to drop for the 30-year down, to 5.5%. Well, there's an inverse relationship between the yield, the coupon, the interest that you receive on that bond is one factor. So you get a bond, it's at 7%, you're receiving 7% interest on that bond. Used to be that you would literally clip interest coupons off a bond. You had a physical bond, you clip the coupon and get your interest. Well, you're clipping coupons and getting 7% interest on this bond, but the yield on the bond changes over time. This means that it has an impact on the value of the bond, and there's an inverse relationship between yields and price of a bond. So if the price of a bond is at 100 I'm just making up numbers, it's 100 when you purchase it with a 7% yield on it, and interest rates drop, the value of that bond will actually increase. It will be greater than 100. So instead of 100, it's 102. So that value has more, that bond has more value to it. And that can be good for bond investors' portfolios. So that's a reason why, yield curve can be an important decision point for investors. Now, it's not the only factor investors consider when they're investing in bonds, whether it's short duration or long duration, but that's just a simple example of what a decision might be and the rationale as to why they would do it. Another area of importance is around the impact on the money supply. When we think about the yield curve, what it does is it influences the ability of individuals and businesses to get loans from banks because it impacts the money supply. Banks borrow money at short-term rates, either from the Federal Reserve or from depositors. And there may be less appetite for banks to do this when rates are higher on the short end. So what happens is that the money supply isn't turning over as quick. So the velocity of the money supply is slowing down, which means that economic activity is slowing down. It's harder to get loans because there's less cash on the bank's balance sheet to lend out. So those are just some factors that are for consideration when you're looking at the yield curve and why it might be important.
Okay, so going back to that picture that you painted for us in the beginning where we had the vertical axis and the horizontal axis being the points of maturity, one of those points is going to be the 10-year yield. Why does the 10-year yield curve in particular matter?
A lot of folks look at the 10-year yield curve because it's an indicator of what the financial world is looking like from an economic standpoint. It's an outlook. It provides an indicator of investor sentiment. So the 10-year yield is often used as the benchmark for other interest rates, including mortgage rates and corporate bond yields. It also reflects the market's expectations of what future interest rates, inflation, and economic growth might look like. So some of these key indicators, some of the rationale we've kind of talked about before, but I'm going to talk about it in terms of the 10-year yield itself. So from an economic indicator, the 10-year yield is a key indicator of economic health. So when the yield is rising, it suggests investors expect stronger economic growth and higher inflation in the future. Conversely, a declining 10-year yield indicates expectations of slower growth and lower inflation. So it does provide some indication of what the economy might be doing. It also helps from an investment decision perspective. Investors watch the 10-year yield to make informed decisions on their portfolios. A higher yield can make bonds more attractive compared to stocks, leading to shifts in investment strategy. So I gave that example around where they might invest in those higher yield long-term bonds, 10-year being a longer term bond. It's not the longest that you can get, but it's a longer term bond, and it's kind of a sweet spot for long-term bond investors to be in that area. since it is such a key indicator of long-term rates, and you aren't locked into necessarily holding a bond that has a 30-year maturity and possibly risking more movement in the price of the bond with a longer duration portfolio. So investment decisions come into play, but the last one I wanted to hit on was around impact on borrowing costs. I talked about the money supply, and so this is where impact on borrowing costs come into play. A little bit different than money supply, because money supply is how much cash is available in the system. The 10-year yield does impact borrowing costs because it acts as that benchmark. So interest rates on loans, talked about mortgages, it also could be auto loans or business loans. It will be impacted by the 10-year benchmark. Higher yields can lead to higher borrowing costs, which impact consumer spending and business investment or continued investment for growth or perhaps acquisitions.
Okay, so why do we look at the spread between the 2-year and the 10-year bond yields? What does that difference between those two tell us?
Yeah, you can think of this as like a litmus test for, what's going on in the markets. So the spread between the 2-year and 10-year bond is an important indicator of what's going on in the financial markets. This spread, so there's a spread, you think about the yield on the 2-year is one number, the yield on the 10-year is one number. The difference between those two, one minus the other, that's the spread, the difference between the two. It provides a way for analysts to monitor what is going on for expectations of future economic conditions, as well as interest rates. So, for instance, when the spread is positive, meaning the 10-year bond is higher, has a higher yield than the 2-year bond, it indicates that investors expect strong or stronger economic growth and higher inflation in the future. This is because long-term bonds typically require higher yields to compensate them for increased risk of holding them over a longer period. A positive spread often is associated with a normal upward sloping curve. We talked about that earlier. If you're looking at a picture going from left to right, it's upward sloping. It suggests investor confidence in the economy and the future prospects. Conversely, a spread that is negative, meaning that the yield on the 2-year bond is higher than the 10-year bond, it indicates that investors expect weaker economic growth and lower inflation in the future. This is often referred to as the inverted yield curve. We talked about that earlier. Short-term rates are higher than long-term rates. So an inverted yield curve is considered a strong predictor of an economic recession. It also suggests that investors are seeking the safety of long-term bonds due to concerns about the near-term economic outlook. So that's why a lot of people are looking at the spread between the 2-year and 10-year. It gives you that, what I said earlier, that litmus test in terms of what's going on in the economy now and an indicator of what may be happening in the future.
Okay, great. So let's take that theory and apply it to today's situation. What's the current yield curve telling us?
That's a great question. And I pulled the current yield curve off the Fed website. It's as of yesterday. So these are yields from yesterday, which is July 30th, 2025. So kind of going back and thinking about the slope of the yield curve and how it predicts direction of interest rates and economic expansion or contraction that could result, the yield curve provides those valuable insights. So remember the difference between upward sloping and downward sloping in terms of one indicating, a brighter future from an economic standpoint, and the other more of a recessionary or less robust economic future. So when I look at, and this is where we haven't talked about this yet because we've only talked about upward sloping and downward sloping yield curves, And I look at today's yield curve, where we're at right now, and it's relatively flat. So if I look at the difference between the 10-year and the 2-year, there is a little bit of difference. The 10-year is at 438. The 2-year is at 394. There's a little difference. It's not massive, but what I'm looking at is the entire yield curve, because the 1-month yields right now are at 441. The 30-year is at 489. And when you look at this, it kind of goes up and down along the yield curve. What that means is it's an indicator of a relatively flat yield curve. So it's not like strongly indicating upward sloping or strongly indicated downward sloping. It's relatively flat. There's not a lot of difference. When you look at yields, are essentially 50 basis points. In this case, it's 48 basis points difference between the 1-month yield and the 30-year yield. That's not a lot. You might expect, oh, maybe there's several percent difference between the two, but that's not what we're seeing right now. So what does a flat yield curve mean? Well, from an economic standpoint, it means uncertainty. Investors may be uncertain about what the future direction of the economy is going to be. Might expect either growth or that it's going to slow down. We really don't know based on just looking at the yield curve itself. Another thing is that it could indicate that we're in a transitionary period. The economy might be moving from expansion to contraction, or vice versa. So, we just don't have a good indication. So it's like you got a crystal ball, but it's totally cloudy. You can't see clearly. And then when we think about monetary policy, this is, what kind of impact does the Fed have on what's going on in the economy? And they have a great impact. The Fed came out yesterday, held interest rates steady. They didn't decrease or increase them. There was some expectation that we might get here in the second half of the year decrease in rates. Right now, the economy is still fairly strong and inflation is up. Now, how much of that inflation is tied to the tariffs? I'll call it tariff war for lack of a better term. But with all the tariff activity, what kind of impact is that having? Is it that our economy just continues to be super strong relative to everything else that's going on out there? And it may be a combination of the two, but jobs are not down. Jobs are still strong. Inflation is still persistent. And so we aren't seeing anything that's indicating that the Fed's going to take action. So, if the central bank was to raise short-term rates, that would be to combat inflation, but we don't have that problem. So, right now, I think investors are looking at this yield curve and they're not exactly sure where to invest along the yield curve. So they might just sit tight around the 10-year for now because you really don't know what's going to happen. So maybe that's a good place to park some of it. It may be that you have some of it parked on the shorter end as well, more of a kind of a barbell strategy. Maybe you have a little bit sprinkled in between because you really don't know what's going to happen. That way, you're able to, if things are changing and the yield curve starts going to an upward slope, you can change what you're going to do with your portfolio. If you have a chunk of it on the shorter end, then you can kind of make some decisions when rates start to go up. It's just really difficult to say what's going to happen in the future right now. So I think investors are clearly uncertain when we look at a yield curve that is pretty flat.
So if I'm understanding you correctly, when the yield curve is relatively flat, a laddering approach, so to speak, might be a wise way forward until things change?
It's kind of a laddering approach, but maybe more of a barbell approach where you got more at short end and long end, and then you have some in between. So it's kind of like a light ladder that gives you more flexibility in terms of, and kind of maybe some insulation in terms of what's going to happen with the yield curve as it moves. So you don't have everything on one end or the other. You're kind of spreading it, but you're kind of like balancing it.
Yeah, that makes sense. So what are the current predictions for the future yield curve?
That's a great question. So we can't get a lot of information out of what we see with the current yield curve. I think indications will probably become a little more clear. One, when we get through all the tariff stuff that's happening, getting that set to the side, which we had announcement this morning that quite a few deals were made. There's still several more out there to be made, but some of the tariff battles are starting to subside, but some of the bigger ones are still out there. China's still out there, Mexico and Canada, and several others, but we've made some headway with other trading partners. At the end of the day, if the end result is lower tariffs for both trading partners, I see that as a good thing. So, I think it could be positive to get past that. I think we could see a shift in the yield curve and we start seeing things move up higher. One of the things that will help with that as well at the same time, one, get the tariffs taken care of, but the other piece would be getting inflation under control, getting an economy that is slower to drop those short-term yields. People want to see the short-term rates go down because that has an impact on consumers' ability to fund activity. It will help with the money supply as well, so you can increase velocity as banks borrow more on the shorter-term rates at the Fed desk or lending. And so you can see an uptick in economic activity, but right now it's kind of uncertain. So, when we think about economists and analysts that are out there, they use that, that yield curve, and they're looking at it going, well, it may continue to flatten or even invert if economic conditions worsen. So an inverted yield curve where the short-term rates are higher than the long-term yields can be a predictor of a recession. I talked about that earlier. Some of the factors that will impact what economists and analysts are looking at would be the global tensions that are out there. There's definitely some global tensions, some saber rattling, some very robust comments between various countries, ourselves and China and Russia, Iran. There's a lot of tension there. I talked about the inflationary pressures, but changes in fiscal policy can also influence what the predictions would be. So central bank actions on how they control inflation, would be something that, going to keep an eye on. So when it comes to the flip side, investors are going to be looking at what's going on, not only with the short-term rates, but they're going to be looking at jobs and inflation. So jobs and inflation are going to have an impact because it's going to impact what happens in terms of Fed decisions. We see a slowdown in the economy. We see inflation subside, and you have a slowdown and inflation is low. Then the Fed is more apt to drop those short-term rates. So we could start seeing an upward sloping yield curve instead of a flat yield curve. So there's definitely a lot of factors out there to consider.
So what logic supports those predictions for the future yield curve? What leads us to those conclusions?
We talked about the future yield curve remaining relatively flat in the near term. I think that's probably going to be what we see perhaps through the end of this year into the first part of next year. So it's that economic uncertainty, the potential for slower economic growth, and there will be an impact of monetary policy decisions by the Fed. So investors are going to be cautious because the outlook is uncertain. They're not demanding higher yields for longer term investments. This also, contributes to a flattening of the yield curve because the market's not pushing it. Other factors that support the logic around geopolitical, inflationary pressures, and change in fiscal policy, are all influences to these predictions. So from economic growth standpoint, it's going to remain sluggish. I think that the yield curve is likely to stay flat or potentially invert. I didn't talk about the inversion, but it could do that potentially. So investors may seek the safety of longer-term bonds during the down long-term yields. But another area is inflation. So if inflation persists, that could lead to higher short-term interest rates as central banks continue, the Fed continues to try to control prices because, nobody's talked about increasing rates. But the reality is that if the economy continues to be robust and inflation continues to persist, and the key inflation indicator, talking about the key inflation indicator that the Fed looks at, if that continues to persist and increase, the Fed might be forced to actually increase rates, which is not something we've been talking about in recent months this year. First half, we were expecting, hey, Fed's going to drop rates. We have a president that's been beaten on the Fed chairman. Hey, you need to drop the rates. He hasn't budged. You got to keep an eye on inflation. Got to keep an eye on jobs as well. Another area is monetary policy. So I kind of talked about the Fed's decision on rates, but it does shape the yield curve. If the Fed was really concerned about inflation and they had aggressive rate hikes to combat the inflation, that could flatten the curve even further potentially. So these policies could have an impact on the direction of what's going to happen. If you're combating inflation, it's probably not the greatest thing that you want to see. As rates increase, it's not good for economic activity. From a geopolitical standpoint, think about those factors between key countries that are economic powerhouses, in particular US and China. There's definitely geopolitical tensions there. And, if that subsides from both an economic standpoint and a saber-rattling standpoint, talking about China considering taking over Taiwan, I call it a takeover, even though China's view is that Taiwan is China. So, there's tensions there. Could there be a conflict from, a military perspective? There could be. What kind of impact would that have? I think that would have a global impact, quite frankly. So demand for safe haven assets and long-term bonds, if the uncertainty continues to persist or gets worse, there's going to be a higher demand for those long-term bonds, which could affect the shape of the yield curve.
Well, Paul, this has all been helpful. Thank you, as always, for your time and insight.
Thanks. I appreciate the time, Brian.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.